Today we have Matt Russell, Investment Director at BankUp. Thank you very much for giving us a few minutes of your day today here in Milan. And for those who don't know BankUp, that must be just a few people, what is BankUp and what's the investment strategy of BankUp?
Sure. No, good to see you. Matt Russell, I lead the secondary strategy at BankUp. A bit of background on the firm. We've been investing in venture capital funds for 4 decades now through primaries and secondaries. Our first secondary transaction was in 1990. We've invested in about 500 individual funds, $3 billion total, through a combination of primary commitments and secondary transactions. And venture is all that we do. So we're a pure play venture specialist.
Wonderful. And maybe we can ask you, why is VC secondaries? It's growing. I mean, there's a lot of interest, a lot of new GPs also looking for this specific asset class. Now, what's going on?
Yeah, I mean, I think it's a much more nascent market compared to private equity secondaries, and has just got a long way to catch up, right? So if you think about the fundamentals driving secondary supply in venture, there's about $3 trillion globally unrealized in venture funds. Private equity is about $4 trillion for comparison. Distribution activity has been at record lows. And so naturally investors look to generate liquidity through secondaries. If you look at the secondary market and the kind of turnover rate, i.e. how much of that primary asset base turns over in the secondary market each year, private equity is probably approaching 3% of that asset base each year. Venture's only 0.5%. So there's a long way, a lot of runway for that to kind of catch up with the much more mature private equity market. But there is a lot of, I think, really important differences and distinctions between private equity and venture, which is why I think you really need that specialist expertise and experience to kind of go after that opportunity in the right way.
And what would you say, because I heard some top LP actually trying to explain what VC secondaries is, and he basically said, it's going and buying, I don't know, Revolut at a discount. Do you think, that's exactly what it is, or it's more than that?
Yes, I think it's important to kind of break down the components of the venture secondary market, right? And I think there's kind of 2 buckets to that, right? There is fundamentally you're getting exposure to venture-backed companies through secondary transactions, i.e. buying from someone. That can take various forms, right? That could be getting exposure to those venture-backed companies through funds, sort of your traditional LP interest secondaries, buying stakes in venture funds that hold those companies. It could be venture or growth managers pursuing continuation vehicles with some of their companies they're most excited about. And there's also a kind of active direct secondary market where people look to buy direct positions in certain companies. It's a little bit like if you talk about the private equity secondary market, the direct secondary market is the kind of the sponsor to sponsor buyout market. That's the kind of comparison if we think about venture. Like for us, and as we think about our business, a lot of the managers we back on the primary side would look to pursue secondary transactions directly in the companies that they are really excited about. And so what we think about when we see deal flow is, why are we seeing this? What is our right to win here? Our heritage and our angle is through our fund investing platform. And so that's where we have an edge.
Wonderful. I'm not sure if this will be repetitive, but what other attributes as secondary fund, kind of funds from your perspective, but also if you're thinking about from the GP side, what other benefits do secondaries bring to the industry, not to this market?
As I said, exit activity, distribution activity has slowed down substantially. We're seeing VC-backed companies stay private for much longer. Many of the very best late-stage technology companies, is really kind of up to them when they go public. And so given the liquidity in the secondary market, whether it's through direct stakes or through buying LP interests of GP-leds, that liquidity allows companies to stay private for longer, which means companies have more flexibility in the private markets. But that combines with giving investors liquidity when they want and need it.
So you would say that right now, because of this slowdown in exit and liquidity, there is even better deals like for the secondaries?
Yeah, I mean, so for us, deal flow has ramped up substantially. Last year, 2024, we looked at around 9 billion or so of venture deal flow. This year, on a last 12 months basis, we're running at over 13 billion. And I think it's not just quantum of deal flow increasing. We've also seen massive improvement in the quality of deals coming to market. I think what we saw a lot of last year was, I think when people look to generate liquidity, they would bring probably their lowest quality positions for sale first. We get approached about a lot of deals where, it's a manager we've never heard of, companies we've never heard of, but we're told the seller will take a massive discount. We pass on a lot of those, all of those. And I think a lot of those transactions ultimately receive no bids. And so I think what sellers have realized is if they actually want to generate meaningful liquidity at reasonable pricing, they need to bring forward quality. Because I think, given, as you mentioned at the very beginning, there aren't many specialist venture buyers out there. Like, buyers can be very choosy about where they want to spend the time. And so, that means sellers need to be mindful of kind of what they bring to market if they want to get interest in the transaction, because it's all about quality in this market.
But we know that this is gaining momentum. Now, how can we make sure actually that happens? That the secondaries market doesn't end up being like a leftovers market, but quality market.
Yeah, I mean, as a function of being a market, right? I think with active participants on the sell and buy side, it will find the right equilibrium. Like, as I said, last year, we passed on a lot of deals, which I think found no bids. This year, we've seen a lot more quality opportunities come to market that have been executed at a fair price. And so I think that's good from a buyer and seller standpoint. What we've seen in terms of our own track record is that, if you look at the last 20 years, we've generated around a 3x on our secondary transactions, which, I think is pretty outstanding considering the diversification profile of a secondary portfolio. But most of that return has been generated by growth of the portfolio rather than capturing massive discount, right? Because if you think about like what we're all interested in the end is how much cash comes back relative to your purchase price. And that's a function of the quality of what you've bought and how much you've paid for it, rather than picking up something at a big discount and crossing your fingers and hoping something comes back.
Now, it just brings us to the next question, which is, we have already sort of covered it now, which is like how important is NAV discounts and is the secondaries, because it's not the only thing that matters, as we were saying before.
Yeah, I mean, I think as a predictor of future cash on cash returns, like focusing purely on NAV discounts is pretty irrelevant as a metric. For us, that's more of a kind of an output of our analysis rather than just a kind of slapping a big discount on something that we don't understand very well. I think you've got some really interesting nuance in venture valuations. So obviously, most common method is venture managers will use last round value for companies, but that can end up being extremely outdated. And that could be an opportunity or a risk as a buyer. But then managers also have discretion around writing down the portfolio. So what we saw in that kind of 2022 to 2024 period was certain companies which raised capital in 2021, certain managers proactively wrote down valuations of their portfolio where appropriate, and other managers continued to hold the same companies at 2021 round. And like for us, that all is typically a signal to the quality of the manager, right? Groups that can proactively write down portfolios are typically those that don't struggle to raise primary capital, those that will hold artificially high marks for a long period of time, typically the lower quality managers. And so what that means for us as buyer is often a smaller discount on a fund that's conservatively valued is much better value on a look-through basis than a bigger discount on a fund that's still holding mediocre quality companies at 2021 marks.
Finally, what are you excited about the outlook for these secondaries?
Yeah, I mean, big picture, right? You've got technology becoming an increasingly larger share of global GDP, I think only accelerated by AI. And you've got that combined with companies staying private for much longer. And so those two things combined, I think, will mean that so much more value capture in technology will be done in the private markets. It will be so much larger as a proportion of total share of private markets. And inevitably, because those companies are staying private longer, investors will naturally look to the secondary market to generate liquidity.
Wonderful. Thank you very much.